Hi, friends. This is Colin Richards, president and founder of Lord & Richards. And once again, I'm thrilled to be with you on this edition of the Lord & Richards Show. And today we're going to address geopolitical instability. As you know, our global climate right now is one of war. And as the Bible predicts, we live in a season that's really been going on for a long time of wars and rumors of wars, conflicts abroad. Thank goodness for us as Americans. We're not seeing conflict here at home, troops on the ground in our country, but we are seeing conflict globally, and it continues. It continues day and night. At times, the U.S. is involved. At times, we're not. But trust me, it's always affecting us. And so one of the questions I frequently get is, hey, Colin, with all this instability, wars, geopolitical problems, should I be concerned about how we're invested and our financial plan? And what I always want to remind the folks that work together with us here at Lord & Richards is, first of all, we've built and designed a plan that is built around geopolitical instability, built around market drops and catastrophes, built around great recessions and depressions. We, at the time that we first begin meeting with you, start talking to you about the potential impact of these things. Whether we're going through them at the time or not, we expect you to go through them. Why is that? Well, most of us, if we retire when we're hoping to, maybe in our early or mid or late 60s, we're hoping for 20, 25, 30 years of retirement. Well, that's a big chunk of time. That's a big chunk of history. And we look back over time here, even in the relatively stable economic and political climate that we enjoy in the U.S. relative to the rest of the world, most of it, we still have seasons of instability, unpredictability, and difficulty. And so far better to be prepared in advance. They say that the person who got on the top of Mount Everest didn't fall there, right? It was a climb, it was a journey, and there's hardships along the way. And in the same way, we expect there to be difficult seasons during your life, during the period that we call retirement, that impact and affect your portfolio, whether it's from within our country or without. And so today we're focused in on really what's going on in the world. But I want to tell you, first of all, as we discuss some planning principles for times of geopolitical instability, the first principle is this: Lord & Richards always has been and remains bullish on the United States. You say, what does bullish mean, Colin? I'm not a financial guy. Well, bullish means that I expect things to long-term continue to grow and move forward. Now, a lot of times you'll hear people on the radio or TV or in the media talking about whether they're bullish on this stock or that stock or bullish on the economy. And usually the focus is, quite frankly, short-term. At Lord & Richards, we couldn't be more different in our outlook. Our outlook is always long-term positivity with a paranoia in the short term, right? We know bad things can happen. We expect them to happen, but over the long run, we expect things to go well. And so we build and design your plan, your retirement freedom roadmap around this principle that we are bullish long-term, first of all, on the United States. You say, well, what about foreign stocks and the opportunities there? Sure, those opportunities are always present, and I'm all for it. We generally have exposure to global equities, stocks in our clients' portfolios and in your plan. And yet, as I compare the performance of the United States to other top performing economies, top economies in the world, I compare real change in gross domestic product. That means, how is our economy growing overall? Not just the performance of individual companies that may be in an index like the S&P 500 and so forth, but how does the U.S. economy stack up to other nations? Well, over the period from right before COVID, Q4 of 2019, all the way through the end of 2025, the U.S. saw growth of 14.9%. Steady, solid. Compare that to the next closest, which was Canada, 10.8, Italy, 7.1, the Eurozone as a whole, 6.8, France, 5.9, the United Kingdom, 5.2, Japan, 4.0, and Germany, a miserable 0.5% in that whole 5+ year period. So what an incredible, actually 6-year period, what an incredible contrast, right? So literally the US grew almost 30 times as much as Germany in that same time period. So I continue to be, I've mentioned this multiple times, and every couple of years I'm going to remind you, put your foot forward when it comes to US equity markets. We have the most favorable economy in the developing or the developed world for long-term growth of stocks, companies, businesses. That's what it really is. When you invest in a stock, you're investing in the business that stock is owned by. You become a little small owner in that large piece of the pie, kind of like Warren Buffett. That's always been his approach. It's one of the reasons he's considered the most successful investor of all time, because he always had the mentality, I'm an owner in the businesses that I buy stock. Now, sometimes he's the majority or the sole owner in those businesses, but the majority of the businesses that Warren Buffett, Charlie Munger, through Berkshire Hathaway invested in over their extensive careers were businesses where they owned a minority stake. Just like you and I do. We have this same exact opportunity. So let's go out and buy great companies in a great economic environment like the US. So that's the first principle during times of geopolitical stability or instability, is to be bullish on the United States. There's more reasons. When we look at just the size of the market available to you, right? When we go out shopping, a lot of times we go to these superstores if we want to get value and discounts and so forth, as opposed to the small stores where we're maybe getting a kind of an idiosyncratic item, right? Well, where is the biggest opportunity to invest? Well, in the same comparison, when I compare the U.S. to other developed countries, we have $71 trillion of market capitalization compared to our next closest competitor, Japan, at 10.7. And that works its way down through the UK, France, Canada, Germany, even China, only 4.2, Australia, Italy, and Spain at the bottom of the list at 2.0 trillion. That's the total capitalization, the size in economic capability of all the stocks and bonds in the United States compared to the rest of the world. So that's literally 7 times larger than the next closest competitor, an even stronger case to invest here. And then sometimes people will ask me, okay, Colin, well, if you're so bullish on the United States, are we in a bubble? Well, I want to come back in my next segment and answer that question for you, and why I don't believe we are, and why I don't think we need to be paranoid in the long term. We need to keep our paranoia focused on what can happen in the next month, 2 months, 3 months, 4 months, and invest accordingly. And in our previous segment, we were talking about why in times of geopolitical instability, I'm really bullish on the United States. And we talked about what's going on in terms of just the size of our markets, which dwarf the nearest market in the developed world. Our domestic product growth over the last 6 years compared to the rest of the developed world. And now I'm going to answer a question that sometimes people ask me, especially when the markets have been going up for a while, which they have. Now, at the time of this recording, we're down a little bit year to date, but we're still solidly up over the past year. And I get asked this question, well, Colin, are we in a bubble? I mean, what goes up must come down. You say that sometimes, and I do, right? I expect that you and I are going to experience, on average, about 3 bear markets. That's the reverse of a bull. That means we're expecting the market to go down about 3 of those per decade. Now, it can be fewer, it can be more. That's just a long-term average. So if you've got a 30-year retirement, we're expecting you to have around 9 or 10 bear markets. That's a lot, right? That's a lot to live through. And so sometimes people get a little antsy when things have been going well in the markets, and they simply say, okay, is it time to sell because I'm at a high? Well, again, timing the market is a fallacy. As people have well said, time in the market is more important than timing the market, because you got to be right on both sides. And you got to do that repeatedly, right? If we're going to have 9 of these, 10 of these over the course of your retirement, how many times are you going to get it right? Well, I'll just tell you, you're not going to win. You're just not going to win trying to time the market, predict a bubble. I sat down with somebody recently who said, yeah, I kept predicting it would drop. I just kept, reading all the doom and gloom, and it never dropped, and I missed out on all the up. I hear that all the time. And so people are so afraid of hitting the down that they miss out on the up. And we're going to talk to you about why Lord & Richards can build you a plan that accounts for that in advance so you don't have to make emotional decisions during periods of instability, geopolitical instability, or market instability. So why is it different compared to maybe other times when we talk about the crash of 2007 to 9 or 2000? Well, one of the major reasons why I don't think we're in a bubble is because households are keeping up on their balance sheet, right? If households were just screaming in debt, if debt was out of control relative to the assets, then I think that would be a red flag and a sign that, America is headed for, a very soon coming downturn. But what has actually been happening is households' assets have been growing much faster than liabilities. I'll give you an example. In 2019, household assets were about $124.4 billion compared to liabilities of $15.4 billion. So you say, okay, well, what does that mean? Well, from 2019 till now, those assets have grown 55% to $192 billion. And yet the liabilities have only grown 28%. So almost twice as fast are we growing our assets compared to our liabilities. That's a good position to be in, right? That's a balance sheet view. Sometimes we'll just pull liabilities out all by themselves and say, oh, American household debt went from $15.4 billion to $19.7. Gloom, doom, gloom, doom. Well, no, I want to look at the net between those two, the net equity. And you've got a lot more equity today compared to just 5-6 years ago. And so I don't believe that we're in a bubble. So let's flip again to this question of geopolitical instability. The question I'm being asked now is, well, Colin, the U.S. is involved in war in the Middle East. Whether you think it's right or wrong is really beside the point. The question for today is, what will that war do to my plan? Should I be investing differently? And the answer is a solid, resounding no. Do not invest differently. Invest wisely and proactively. In the meantime, here's what I'd like you to do. I'd like you to grab your phone and give me a call because I'd love to visit with you together with my team and talk to you about how you can develop a retirement freedom roadmap. This is a process that everyone goes through for free at Lord & Richards. Our planning is completely free, and we want you to be prepared for retirement. And so it just starts with a simple phone call.